high dividend stocks in Bursa Malaysia for this year. These stable Malaysian dividend stocks are currently giving 5% or above just for dividend returns. Number 1, we have Magnum Berhad. At the current price, dividend yield for the past 12 months at 5.2%. At the heart of Magnum Berhad operation lies a simple but ingenious concept: selling little slips of paper printed with tantalizing numbers. Think of Magnum as the master puppeteers of hope since 1998, dangling the carrot of riches before 80% of the Rakyat by a simple act of scratching a few numbers on a piece of paper. But Magnum Berhad does not just peddle dreams, they've turned it into an art form. Their outlets are strategically scattered across Malaysia, beckoning passersby with the promise of untold wealth. It's like a siren's call for those seeking a quick fix to their money not enough problems, especially during times when Ringgit is at its weakest for decades and inflation is eating your salary like nobody business. Magnum has managed to weave itself into the very fabric of Malaysian culture, at least for the non-Muslims. It's like they have tapped into some primal human desire for becoming an overnight millionaire and turn it into harmless fun, at least until you find yourself checking your pockets for loose change to try your luck one more time. Who knows? One day they might even launch their own line of luck charms or talismans, because why not capitalize on the desire of the B40 and M40, making their get rich quick dreams come true legally. For the past 1 year, its stock price has been on the uptrend. Although compared to the broad Malaysian stock market, the share price has been historically stable with medium-low beta. However, it may change for the worse in the future. So if you want to stay up to date, do follow and subscribe if you prefer weekly email update. There's a link in the description below or in bio. Now, how likely is this dividend payout can be sustained or even go higher in the future? For this, we look at its net margins. Turn out it is a low margin business, no more than 10%, even during a good year when you divide profit after tax with revenue. For the past 5 years, Magnum profit growth had been affected badly by the pandemic, only been picking up recently in the high teens. Now, disclaimer, this is not investment advice. This is also not a recommendation to buy Magnum. I mean the dividend stocks cover, as I do not know your financial needs, circumstances, risk appetite or investment objectives. Then next, we want to look at these stocks' dividend risk to you. For this, we look at a company's leverage and show to the extent into which operations are funded by lenders versus shareholders. Gearing ratios are financial metrics that compare a company's debt to some form of its capital or equity. They indicate the degree to which a company's operations are funded by its debt versus its equity, highlighting the financial risk companies assume when they borrow to fund their operations. Gearing is your total debt minus cash in hand divided by shareholders' fund. Ironically, for Magnum, it still needs to sell medium-term bonds as a way to finance its ongoing operations with a gearing of 36%. Number 2, Mah Sing Berhad. At the current price, dividend yield for the past 12 months stands close at 5.6%. Mah Sing acquires vast swathe of land and proceeds to turn them into self-contained mini metropolis, complete with residential areas, commercial centers, and even amenities like schools and parks. It's like they are playing a real-life game of SimCity, but without the risk of accidentally demolishing half the town with a misplaced nuclear power plant. And the best part, they named these townships with a flair for the dramatic. You've got your Southview City in Bangi, which sounds like a place where all the cool kids would want to hang out. And then there's this Meridian Bayview in Johor, which evokes images of majestic mountains and rugged terrain, mimicking the Swiss Alps, even though it's probably just a bunch of high-rise condos. But hey, who am I to judge? At least Mah Sing is keeping things real and interesting in the world of property development. Instead of just slapping up a few houses and calling it a day, they are going all out and creating an entire communities from scratch. It's like they are playing a real-life monopoly, but instead of buying properties one by one, they just straight up building the entire board game set. For the past 1 year, its stock price has been uptrending double to be precise. The fact that dividend yield still at its current level despite price has gone up 100% is commendable. Imagine holding Mah Sing stocks at 60 cents per share just 1 year prior. Now, how likely is this dividend payout can be sustained or even go higher in the future? For that, we look at its percentage net margin that ranges from 5 to 10-ish% for the past 5 years. Growth-wise, bouncing up and down in the same period. As usual, the next thing to do is to look at this stock's dividend risk to you, checking for possible red flags. Now, in finance, a gearing ratio refers to a company's financial leverage, how much debt they use to run their operations. That can help a business grow faster, just like in racing. Higher gears lead to greater speed, but too much debt can cause problems. If interest rates rise unexpectedly, heavily geared companies get into financial trouble overnight. Unlike most real estate property developers, Mah Sing is in a low gearing position with nearly 1 billion in liquidity. It is in an enviable position to sustain its profit growth and net margin without major issues. Of course, this may improve or worsen in the future, so if you want to be aware of future changes, do follow and subscribe. If you prefer weekly email update, there's a link in the description below or in bio. Questions, ask below. Here's your next high dividend stocks clip to watch. There's an entire series of this. Also check out more of these global investment strategy videos updated monthly only for CF Liu channel insider members.